Hi, I'm Michael Harris. I'm with the New York Stock Exchange, and this is Going Public. We're pleased today to have Scott Sandell from NEA join as a 30-year veteran of the firm. Scott, thanks for joining. Tell us a little bit about yourself.
Well, it's great to be here with you, Michael. I joined as NEA in 1996, as you said, and I was trained as an engineer. Joined my first startup at the age of about 23, Cat Software. Would be called a fintech company today. Went public on the New York Stock Exchange. After business school, I worked in product management at Microsoft. Those are both great experiences for what I do today. But I joined a firm at the time which had, I think, $500 million of capital under management. It's just been an incredible ride.
You've seen a number of interesting cycles during that time period, whether it's the rise of web, e-commerce, mobile, social, and now obviously AI. So as you kind of think about this current cycle relative to some of the other super cycles that you've seen throughout your investing career, how does this stack up?
Well, I think there's two things to keep in mind, Michael. One is the cyclicality of the venture business itself, and then the secular trends that layer on top of that. As you already said, we're in a secular trend of artificial intelligence, and I would say we're pretty early on in that. That will probably run 10 or 20 years, maybe 50 years. But we're also in, I think, the middle innings of a cyclical change in the venture industry. Obviously when interest rates went up 5%, risk went off, not just in the public markets, but the private markets. Capital flowing into the ecosystem dried up substantially. And so there's, everything drives, sort of a purging of the ecosystem that I think we're coming out of now. The really great companies have survived, they're getting funded, they're growing fast. But it was a big readjustment. I mean, it wasn't that long ago that it was growth at all costs, and now all you hear about is the rule of 40 and when you're going to be profitable and so forth. So I think we're in the middle innings of that transition. The IPO market is still relatively nascent, but there's no doubt it's starting, it will become more and more attractive because, through that period of time, more and more of these companies have matured to the point where it makes sense for them to go public.
So obviously interest rates have changed dramatically over the last couple of years. So we now have companies that are dealing with a much higher cost of capital. So as a private investor, how has that changed your own approach in terms of making investments into companies now versus where we were 5 years ago?
Well, I think the main thing is capital efficiency. If capital is expensive, and it is a lot more expensive than it was, then you're thinking more about how efficiently a business is going to create a product, go to market, attract new customers, what the value of those customers compared to the cost of acquiring them is. All of those things add up to capital efficiency. And I think the businesses that are getting started today and the businesses which have come through this part of the cycle are much more capital efficient than a lot of the businesses we saw in 2020, 2021.
Yeah. And for public markets, you kind of think about the rule of 40, we talked about earlier, and there's always that trade-off between, growth, margin, profitability, and how do you kind of see that trade-off today in terms of public markets? Well,
I mean, growth is forever the elixir of Wall Street. So, the fastest growing companies will always trade at a premium. But the markets today are very focused on how quickly you will get to profitability, how efficiently you are achieving that growth. That's what the rule of 40, is all about for people who haven't heard the rule of 40. That's obviously revenue growth plus net margin, operating margin. And so we were looking at a business in our own portfolio yesterday. I was just kind of getting caught up on it. They're growing 20% at the top line, but they're going to grow operating margins net positive 21%. So they're a rule of 40 company, even though they're only growing 20% in terms of revenue.
Yeah. You've obviously done this multiple times through different cycles. What are some of the things that you're seeing that are similar in this environment versus other environments that you've taken companies public in? What are some words of advice that you'd offer that are just essentially evergreen in terms of as you think about going to the public markets?
Well, as it relates to where we are right now, as I said, I think we're in the early stages of a new IPO market, and companies that go public in that environment have to be very mindful that most investors have not been participating in the IPO market. they need sort of an extra incentive to jump off the iceberg and into the cold water, right? And that usually means some kind of very attractive valuation. A lot of management teams especially, and sometimes boards, think that the best thing to do is get the highest possible price on the IPO, and they forget that the very next day, that's the price they'll be measured against for the rest of time. So going out, yes, you get a little bit more dilution, maybe you size the offering down a little bit to manage that, but you want to get, as we say, the puck on the ice at a price that can grow. And I think, in this part of the cycle, that's going to be essential. Mm-hmm. In terms of advice that is, sort of evergreen, as you put it, I always tell our management teams, you can only go public once. I mean, obviously companies get taken private all the time, but for the team that's taking your company public, this is not something you can reverse. You want to be ready to be a public company, and realize that, all of the things you ever say as a public company, all the metrics that you give the street are metrics they will never forget and they will track you by. So if your business is not predictable, and if you're growing, if you're a Rule of 40 company growing really nicely and moving towards profitability, how consistently are you going to be able to do that?
All right.
That's really critical.
Yeah. And I think another question that often comes up is, to that point, what scale do I need to be in as a business in order to get to the public markets? Mm-hmm. How do you think about that? I actually did a little homework on this question just for my own edification, using Perplexity. I just said, what are the market caps and revenues of the last 5 tech IPOs or something? Yeah. It came back and said it's really all over the map. It depends on sector and so forth. I think what's more important, you probably do need to, different sectors are valued differently, different growth rates are valued differently, and so forth. Sure. But you probably need to have a market cap measured in at least the single-digit billions of dollars, probably ideally 3, 4, 5 or more. And so, again, different companies will be valued that way at different sizes. Mm-hmm. I think, growth is the elixir of Wall Street. You want to be a rapidly growing company, but I come back to predictability. Predictability is really the critical thing for going public. Yeah. It's very hard to, change all 4 wheels in a moving bus. And once you're a public company, that's what it looks like. Yeah. And you think about the $3 to $5 billion as more from just a technical standpoint of being able to get enough liquidity into the marketplace where you get enough of the important investors that line up behind the transaction and support in the aftermarket. Is that how you think about it? I mean, you guys would know better than I do, but most investors don't participate in, the microcap market, wherever the definitional cutoffs are. You don't want to be below that. You want to be out in the territory where you have liquidity because you have broad participation. Right, which I think kind of brings up another topic we were talking about earlier, which is not every company necessarily should go public. So as you kind of think about that filter process around companies that might be aspirational to get to the public markets at some point, but should think about staying private, what are some of the things that they should be asking themselves about whether or not they are ready now versus just waiting? Well, I'm probably starting to sound like a broken record with respect to predictability, but what's behind predictability? Yeah. You have a product line which you can take to customers. You can predictably grow that business. You know what kind of a return you're going to get by hiring the next salesperson or running the next advertisement. All of that go-to-market engine is well instrumented, and you have dials and knobs that you can push and drive your business predictably. The other thing that you have to think about is innovation. Do you anticipate that in order to maintain, that growth, you're going to have to invest significantly in innovation, because that's hard to do in the public market if it detracts meaningfully from your ultimate profitability. So we have companies in our portfolio that have chosen to stay private because they had, a big, innovation agenda. Databricks is a company like that. They've actually meaningfully benefited from staying private longer. Yeah. Yeah, absolutely. And in your own pipeline, what are some of the things from an innovation standpoint that are kind of really capturing your attention right now? Oh my goodness, There's so many because you have a big portfolio. So. We have 500 companies or something, but it's drinking from a fire hose. And I think what is really exciting is to see the many, many ways that our artificial intelligence is being put to use across every business, whether it's a
consumer-focused business and enterprise-focused business, it's stunning. I mean, we were talking earlier about Synthesia, which is one of our European companies. You know, they can synthesize voice and video so well that you, as the vice chairman at the New York Stock Exchange, can communicate with your employees through effectively an avatar of yourself. And it turns out to be compelling.
Yeah.
And now they're using it for communications to customers and other things. I mean, who would have thought
It's fascinating. Yeah, it's fascinating. When you kind of think about, kind of the next 5 years, for instance, whenever I hear people making predictions for 10 years, I think it's difficult just because so much changes from a technology standpoint in 10 years. But what gets you excited about 5 years from now, or what do you see 5 years on the horizon that's going to be impactful from a super cycle standpoint?
I mean, I think broadly speaking, 5 years is roughly the period of time it will take for AI to mature into products and services which each and every one of us can use, and the time for most of the human race to know how to use them. So that 5 years from now, we will all have a bunch of things, AI agents or capabilities at our disposal that we will be comfortable using in our home life and at work, and I think it'll augment our productivity and hopefully our happiness.
So, Scott, one thing I think it's kind of an interesting dynamic is you've worked with so many different companies in the context of going public. What are a few examples that stand out? Maybe name one as far as a company that maybe defined its category and really became kind of an interesting IPO candidate, but also obviously an interesting candidate just from the standpoint of an industry and defining it for itself.
Well, we've been talking about the fact that we're kind of early on in a new IPO cycle, and so that for me brings back Salesforce 2004. If you think back to the dot-com implosion, there's nothing in my career that was as dramatic as that.
Yeah.
And so, the first penguins off the iceberg were few, but it set up Salesforce in particular, I think, set up a new wave of companies that, some of which are still around, and Salesforce is obviously one of them.
Yeah. Do you recall what they did that was so interesting from the standpoint of kind of defining their category that you knew at the time would really kind of set them apart?
I think Mark is a brilliant marketer, for one thing. I mean, we were involved in an earlier company called WebEx, which was also a great SaaS company, but the term SaaS didn't exist back then. And Mark, of course, had this idea of, no more software, and, he made it easy for people to understand why this was a new business, a new way of delivering, computational capability to end users. And he also targeted a very broad market. Almost every company could become a Salesforce user, which is, I think, an essential category of companies that can become very, very large, which obviously Salesforce.
Yeah, defining the enterprise space, really owning the enterprise space. And that's something which he continues to do, which is truly just inspiring in many ways.
He is very inspiring.
Yeah. A lot of the conversations we have with investors as they're kind of making their way through the IPO process involves multiple rounds with investors. The testing the waters process has become much more extensive for a lot of potential companies that want to go to the public markets. On one hand, I think a lot of it goes back to the higher cost of capital. There's a higher hurdle to be a public company now than there probably was, 5-6 years ago. And at the same time, I think there's also the element where the companies that are getting to the public markets, they are just much more mature. So, as you kind of think back, are there examples of companies that, really did that well? You talked about Salesforce, but also are there kind of pieces of advice you'd recommend along the way, or kind of an example you could point to of a company that managed that process well?
I mean, the one that comes to mind for me is Tableau. And one of the reasons is that no one on the management team had taken a company public before. So, the bankers told us, for example, you want to have at least the CEO or the CFO with that experience. And we didn't have either one. And we loved both of them. And we decided that Tom Walker, who was the CFO, deserved the chance, if he was given the right mentorship. So we brought in one of our venture partners, Brooke Sewell, who's taken 4 companies public as a CFO, now the chairman of the audit committee at NVIDIA for the last 27 years or something. Very experienced guy. And he has a whole playbook for coaching companies on IPO readiness. And he coached Tom, and it was obviously a very successful offering. But that started 2 years before they went public.
Yeah.
And every quarter, you know, instead of just having a private company board meeting, as an example, they would have an earnings call.
Right.
Just to practice.
Right. And I think that speaks to just kind of where we are in the cycle currently. Like, companies are, in many respects, much better prepared to get to the markets than they probably were in 2000 or 2010. The work is being done ahead of time. There's a lot more preparation that's being done. And the management teams, I think, are also prepared to meet that challenge. You know, as you kind of think about the next layer of advice, you know, for, let's say, a board that is thinking about taking a company to the public markets, what are some words of advice for a board as they kind of think about that process?
Well, I think first of all, and this was true at Tableau with, you know, people like Brooke Sewell joining the board, but the board itself needs to evolve. You know, it's not just the requirements of the New York Stock Exchange for boards, but, you know, typically these private companies have fairly small boards, and they may have a lot of investors, for example, and a few founders. Maybe they have a CEO that came in after the company got started. It's not the founder anymore, but they need to build out the expertise on that board to provide the right kind of governance and ultimately, you know, the right kind of mentorship to the management team.
Yeah. And what's your sense of how long that process needs to play out? Like, how soon should a management team think about bringing in new board members, getting independents on the board in order to get them ready for the IPO process?
I mean, I think it could be 18 months to 2 years.
Yeah.
And that's not the answer anybody wants to hear, by the way. And I've certainly seen companies that have tried to do it very quickly. We did it very quickly at Robinhood, and fortunately it worked out. Okay, but boy, was that a lot of stress to get great people, and we did on the board. But I think it was less than a year.
Yeah, yeah. You know, I think you hear a lot about the conversation we've had today, and I think one takeaway could be, wow, Scott, this is a lot of work. There's a lot of stuff that I have to do as a CEO or a CFO or a board member in terms of getting my company ready to go to the markets.
I think it's another thing that people need to be mindful of. We tell our CEOs, you need to be able to spend about 30% of your time on this. And so that's another aspect of being ready to be a public company. If you haven't structured your team in such a way that you have 30% of your time available for this, you might want to take a little bit longer to build out the team so they don't need you involved in so many of the things that you're currently doing. So that's one thing.
So, you know, Scott, we talked about kind of the benefits of certain companies going public. Obviously, not every company should go public, but what do you see as kind of the benefits for companies that are ready to go public? Why should they go public? Why should they consider the public markets relative to private capital?
Well, I mean, if a company has all the things we've talked about and it has the kind of predictability, which is, you know, fundamental to being a public company, there's no forgiveness for unpredictability as a general rule. Then, first of all, the IPO itself is perhaps the greatest marketing event in the history of the company. I remember Mark Benioff getting all excited about what the New York Stock Exchange was going to do for you guys, you know, for Salesforce, and I think that proved itself out.
Yeah.
So it's a marketing event. It's also a level of transparency which is required by some enterprise customers, helpful to other ones. I mean, most of the companies that I've seen go public get this kind of boost of inflow of customer demand in the 6 to 12 months after it comes in, but it impacts their business 6 to 12 months later. Because they have such exposure. I mean, you guys know better than I do how many media outlets are in the New York Stock Exchange every day, but it's a level of exposure you can't get any other way.
Yeah, and it helps in the procurement process as well, because a lot of your information is already public.
Yeah, no, that's right. That transparency is critical to some people.
Absolutely.
Not to mention the balance sheet and, you know.
Yeah, absolutely. You know, kind of thinking about public markets versus private markets, obviously you're a big investor in private capital, you've participated in public markets. Kind of where do you see the state of play in terms of the growth of private capital relative to public markets?
Well, the last time I saw an estimate of this was about $3 trillion in the US of private venture-backed companies. That's a historical high by any measure. And so, I think because we're at the beginning of an IPO cycle, some of that will get out the door into the public markets, and hopefully it's mostly the ones which should be public companies. But as we've talked about, not every company is going to achieve that outcome.
Right.
And so personally, I'm a big believer that the private markets also have to achieve new levels of liquidity, because there's a massive illiquidity problem in the private markets generally.
Yeah. Any advice that you'd offer startups that are kind of in the process, that are kind of thinking about going public? Maybe it's not this year, but it might be a few years from now, as they kind of think about that journey. Obviously, preparation sounds like that's one big takeaway, making sure that you have a board management team that are ready to be public ready.
I think, the main thing that comes through in all the questions we've discussed with this is just how long it takes.
Yeah.
So if you think you might want to be public 2 years from now, it's not too early to begin thinking about what you need to do in those 2 years. I would say even 3 years would be helpful. And most people just don't think that way. One of the things you see a lot is a pre-IPO round. And, that does a number of things for a company. But one of the things that it does is it provides some liquidity typically to the founders and the management team, so they have less of a need to trade in the public market where they're going to be highly scrutinized for trading. Right? It often allows some of the early investors to achieve a little bit of liquidity, so that takes the pressure off, once the company is public, of too many investors wanting to sell, because you want to have an orderly transition to the cap table. You don't want to have any of these high pressure moments where a whole bunch of people want to sell and there's not enough people who want to buy. So the more of that pressure you can take off before the public offering, the better.
Scott, you've worked on a lot of IPOs. Maybe take us back to the first IPO that you worked on.
Oh, the first IPO is always a memorable one. In my case, that was Mission Critical Software. It was a systems management software company built for Windows NT. That's
what year is this? Do you remember?
This is, we invested in the company in 1996. I would guess the IPO was in 99.
Oh, tough year.
Something like that. Yeah, I think it was.
Actually, I guess it was before the crash. So
I think it was in 1999.
Good timing then.
But what I remember was that it was a terrible day in the markets. And our banker was Christina Morgan, who at the time was the vice chairman, I think, of Hamburg and Quist, a name that doesn't exist anymore. I think it got acquired by J.P. Morgan ultimately. But she was a very seasoned hand, and she'd been at this a long time, which is very helpful in a tough situation. And I remember her telling the board, for two things. One is, it's not so bad to get public at a lower valuation in a tougher market, because you'll always be measured against that price.
Right.
So if it's a lower price, it's easier to go up.
Right.
And the second thing she said is, growth is once and forever the elixir of Wall Street. And we had a high growth company, so it went very well after that.
That's great. That's great. Kind of looking forward, what are some of the things that you look forward to in 2025 and beyond that are getting you excited?
I mean, I just think that the breadth of the opportunity is the most exciting thing. It's not one or two companies. It's, I mean, even this week we've seen 3 different companies. One is a transformative cybersecurity company that uses AI, on the defensive side. I think it's going to be a complete game changer. Another one is revolutionizing, again, using AI, 9/11 services. I mean, just think about the number of different places it can be applied. And, it's been around a few years. So these things are starting to come out of the woodwork with real meat on the bones.
Yeah. Which also sets up for kind of the next layer of growth 5 years from now, because there's going to be permutations coming out of that business, which are going to be also fascinating.
Yeah, and these businesses will be, ready for you guys in 5 years.
Yeah.
Or less.
Certainly hope so.
Yeah.